There is a reason IUL and Be Your Own Bank videos are becoming more and more popular online right now, because they promise something that everybody wants. Become your own bank. How cool is that? Get stock market gains with no downside. Tax-free retirement income. They're designed to feel like you just discovered some secret that only wealthy people have been hiding from everybody else. But once you dig past the marketing and start hearing from the people who actually own these policies, you start hearing a much more nuanced story. So in this video, I want to break down the 3 biggest claims some insurance people might tell you about IULs, whole life insurance policies, and becoming your own bank. And to be clear, I'm not saying these products are always bad. I'm saying the way that they're often marketed can be incredibly misleading. Quick disclosure before we dive in, I'm a CFP professional and investment advisor representative. I am insurance licensed, but I've chosen not to sell insurance products in my current practice. These are my professional views based on what I've seen working with clients, and this is for educational purposes only. It is not individualized investment advice. Misleading claim number 1, you're becoming your own bank. This is probably the most emotionally effective sales pitch in the entire insurance industry because it sounds empowering. Stop using banks, take control, borrow from yourself. Except that's not actually what's happening. When you take a policy loan from a whole life policy or an IUL, indexed universal life, when I say IUL, you are not withdrawing your own money like you're withdrawing it from a checking account. You are taking a loan from the insurance company using your policy as collateral. That's a meaningful difference. If it were truly your own money, you wouldn't be charged loan interest. And many of these policy loans carry rates of 5 to 8% depending on the policy and current interest rate environment. That means on a $100,000 loan, you're paying $5,000 to $8,000 per year in interest while being told that you're using your own money. Now, to be fair, your cash value may continue growing while the loan is outstanding. Some policies use what's called a wash loan or participating loan structure, where the credited rate roughly offsets the loan interest. That's a real feature and it is worth understanding. But the loan interest is still real, the policy expenses are still real, and the net effect depends heavily on assumptions that don't always play out the way that the illustration suggested. Meanwhile, you didn't eliminate the lender, you just changed who the lender is. And this is where many people later realized the presentation highlighted some potential upsides while barely explaining the trade-offs. That leads me to misleading claim number 2. This is how wealthy people avoid taxes. This is incredibly effective marketing because there's just enough truth mixed into it. Yes, some ultra-wealthy families use permanent life insurance as a part of their financial plan, but why they use it matters. They may use it for estate planning, liquidity, business succession, advanced trust planning, or legacy strategies. That is very different from a 32-year-old being told an IUL is the greatest retirement strategy ever created. Or in one of the worst stories that I've seen, 50-plus-year-old being told it's a good way to pay off your student loans, which actually resulted in her taxable income going up because she took money from her IRA to put it into an IUL. And this is where the marketing becomes effective because the presentation creates this feeling like rich people discovered this secret loophole, when in reality, most people didn't get wealthy because of an insurance policy that they purchased. They invested consistently, they owned appreciating assets, and they stayed disciplined for decades, not by financing vacations through insurance policy loans. Now, anecdotally, something I've seen repeatedly is people eventually realizing the strategy sounded much more compelling during the presentation than what played out in real life, because the marketing often makes these policies sound like an investment account, a retirement account, an emergency savings fund, a bank account, a college savings account, a life insurance policy, a savings account, all at the same time. And usually when a financial product claims it can do everything, there are trade-offs being overlooked somewhere. In this case, often high internal costs, increasing insurance costs that people don't fully understand, and illustrations that look dramatically better on paper than what happens in real life. Misleading claim number 3, you get stock market gains without downside risk. The pitch usually goes, you participate in market gains, but when the market crashes, you don't lose anything. Many IULs have a 0% floor, meaning you won't be directly credited negative returns in a down year. But here's what often gets minimized: cap rates, participation limits, spreads, insurance costs, meaning you usually do not get the full upside of the market. It's really easy for people to emphasize the no downside risk while glossing over the capped upside risk. Where if you're in the accumulation phase of life and you're looking to build your wealth, and one, you have higher insurance costs than you understand, and two, your investment is actually capped, you can really put yourself backwards by buying into this be your own bank narrative. This compounds over decades. An illustration assuming 6.5% credited annually for 30 years looks dramatically different than one that shows 4.5%. The rules around how much upside you can capture are not locked in forever. The insurance company can dial them back over time, and there's often very little in the contract preventing them from doing so. If reality turns out materially worse than the illustration you've been shown, the policy can become increasingly difficult or expensive to maintain, and in some cases, people who believed they were building tax-advantaged retirement savings end up facing a policy lapse or the need to continue to contribute far more money than they originally expected. That's a very different conversation than what they were told up front. It honestly breaks my heart when I meet people who feel like they've been completely misled. And among the complaints and reviews from long-term policyholders, you'll find a common thread: an eventual moment of realization, this is way more complicated than I thought. You'll also hear people say, nobody explained the fees. I didn't realize how long I had to fund this. The illustration made it look much better. Wait, I barely have any cash value? How is that possible? Some people don't realize that these policies can take years before the cash value meaningfully catches up to what they've paid in. The New York State Department of Financial Services has issued consumer alerts warning that many universal life insurance policies rely on assumptions about future interest rates and policy performance that may not hold up over time. The regulator specifically warned that some consumers paid premiums for years, believing their coverage would remain intact, only to later face rising costs, additional premium requirements, or policy lapse risk. In other words, even government regulators have warned consumers that these policies can behave very differently than people expect. So when do these products actually make sense? I'm going to go over a few real scenarios. High income earners who've already maxed out their traditional retirement accounts, HSAs, and other tax advantage options, they may consider a well-designed permanent life insurance policy as an additional planning tool. But this is a fairly specific scenario. For many people, a simple brokerage account may ultimately align better with their goals, flexibility needs, and overall cost structure. Estate planning for larger estates, irrevocable life insurance trusts, or ILITs, are a legitimate and widely used estate planning tool. If your estate faces a potential tax liability, the death benefit can provide liquidity that other assets can't. Business owners with specific needs, so key person insurance, buy-sell agreement funding, and executive benefit structure are real use cases where permanent life insurance does what other products can't do as well. Notice what these have in common. They're very specific. The insurance is solving a defined problem, not acting as a catch-all miracle product. For most people, I've found this to be the case. The simpler path is probably the better one. At the end of the day, complexity sells in finance because complicated financial products are easier to position as exclusive or sophisticated, and what wealthy people do. So anytime someone pitches you a financial strategy that sounds too good to be true, especially one involving a large insurance policy, here's what I'd encourage you to do. Ask how the advisor or agent gets compensated if you move forward. Ask what alternatives they've considered for you. And ask them to walk through the trade-offs, not just the upside. Different compensation structures exist in the financial planning industry, and this is not a moral grandstanding to say one is better than the other. It is to help you make an informed decision. The goal is simply to understand the incentives, the cost, and the complexity before you make a major financial decision. A good advisor should be completely comfortable having that conversation. Thank you for listening. Please hit subscribe. And as always, money is a tool, knowledge is freedom, and planning is power. Have a great rest of your day.